I'd like to open this back up across the debt side with ABS and also this equity product in this interest rate environment, right? You look at the risk-free rate is 5%. It becomes, a challenge for yield-oriented, other yield-oriented products, right? They have to be competitive with that. Minerals is a lower yield investment versus a working interest, in terms of risk. So, what the numbers you're talking about in terms of where the industry typically trades, I think that's very, very compelling. But, a lot of these investors will not be NCAP, right? Without raising money for oil and gas, and their job is to deploy money in oil and gas. Their job is to maximize return and be industry agnostic. So when you're going out with your retail squad, educating the market, when you're working with the insurance companies on ABS, where interest rates have climbed in the last year, what is that conversation like in terms of comparing the alternatives out there and how attractive these can be?
We have this debate a lot internally. It's funny, the industry, despite interest rates, we've always talked about PV10. SEC does it on a 10K. There's always a supplied discount rate of 10%. It's just been the standardized number across uniformly over decades, really. And so, I believe those spreads actually tighten, and a function of that's going to be people's expectation of price. People are buying this product because they want access and exposure to oil or gas prices, the commodity itself over the longer term. So, we price everything on a NYMEX curve, daily, like we talked about NAV. As you run different scenarios where oil goes to 100 or oil goes to 60 or gas goes to $6 or gas goes to $1, the performance of that investment changes. You can generate 25% rates of return with an escalated price deck, but you can also lose a third of your money with the deceleration in price. I think you mentioned that it's we're just trying to create a product that gives true access to the commodity itself. We're not levering it. We're offering hedges for some reduced volatility. You think about private equity. I think a lot of the private equity firms, for a while there were simply LBO shops. They were out trying to lever and buy low, sell high on a large PDP allocation. And I think some did very well there, others didn't perform as well. I think where you see Quantum succeed and NCAP succeed and some of these others was their true value is the development component, really converting acreage or minerals to production, and then how do you sell that production. And I think you'll see again, we think two asset classes within upstream. You'll see hopefully us as the production conduit and private equity more of that 2 and 20 25% rate of return targets that'll be more focused around development.